Hey guys, Damon Varial with a new microphone. If you can hear a difference, let me know. Hoping this is going to be good and work for a podcast. Today we're going to be talking about investing and trading gurus, and I'm going to give you a really cool piece of advice to help you to decide on stocks to pick and stocks to sell. Now, when you talk about gurus, this is the type of person you think of, someone with a beard, or that's what the media tells us to think of. I have no idea. I don't know why they're always depicted as having beards. But the idea here is that we are going to be listening to someone and deciding on what stocks to buy based on that person's advice. That's really the point of a guru. Now, in the investing and trading community, you've got good gurus and you've got bad gurus, and then you've got gurus in the middle whose advice is essentially the same as getting random advice. So it's the same as a coin flip. Now, on the one hand, the investing gurus that give good advice probably have some sort of method that the average investor doesn't have. He knows how to pick stocks. He knows where stocks are to go. It could be fundamental, technical analysis. It really doesn't matter, but he probably has a method. So I don't ever call myself a guru, but I have a subscription service. So obviously, I believe that my trades and my investment advice is worth money, and I put it behind a paywall. Now, most good investors, not all, will put their most good investing gurus will put their advice behind a paywall. But that does not mean that everything behind a paywall is worth paying for, because some gurus are just good at marketing and they will put their stuff behind a paywall, and once you get behind that paywall and subscribe, you will find that they don't really give you any good advice. It's kind of like a coin flip. It's like those middle ground investment advisors and gurus that are right half the time and wrong half the time. Unfortunately, you don't get to figure that out until you are actually subscribed and you're behind that paywall and paying money. So in the investments advice community, we have something called the retention rate. Retention rate, that's the percentage of people who stay with you after they sign up for your service. Now, fortunately, I have a really high retention rate relative to the industry, which tells me that the people who've signed up are actually finding my trade advice useful. So I think the average in the market is in the investing advice market is something like 20 to 30%. My good friend Todd Bubba Horowitz, this guy was the one who told me that the retention rate's pretty low. It's like 20% or something. And he has a pretty high retention rate himself. I think actually his is higher than mine. He gives not only does he give good advice, but he's also well known. He's on the news often. So there's an extra benefit of signing up for his service, and that is that you get to be part of a group that's led by someone who's on the news often, which means, he's got some sort of prestige attached to his name. Now, Bubba's legit. Bubba's a legit trader. He started out at the very beginning of the options market, and he knows what he's doing. So obviously he's going to have a pretty good retention rate if his trades are good. Now, my retention rate at the moment is above 50%. I haven't calculated it recently, but it's at least 50%. I think it's considerably higher than that, actually. But what I want to tell you is that, let's say you don't have money and you aren't confident at the outset to design your own trades, so you're not going to sign up for my service or Bubba's service or anybody's service, but you still want advice and you want to know how to pick the right guru. I'm actually not going to tell you how to choose the right guru because I didn't plan on making a video about that. Instead, I want to give you a different idea. And this idea is simply, instead of finding a good guru who's constantly correct, you should find a bad guru who's constantly wrong. Now, remember, there are three types of gurus. There's the middle guru who seemingly invests randomly. He's probably choosing based on intuition. He doesn't have a system. Now, what separates the good gurus and the bad gurus is that their systems are either good or bad. It's that simple. So I don't ever call myself a guru because I don't have some sort of special ability that allows me to predict the way a stock's going to move. I have a system that works. So all of my predictions are actually not my predictions. They're predictions from the data. They're predictions from the statistics, the numbers, the algorithms that I run. Everything that I predict is based on actual facts. It's not based on some sort of feeling that a lot of investment gurus purport to have. So a lot of these guys will be like, I have alpha. And if you don't know what alpha is the idea that you can consistently beat the market. So if you ever go to this website that I write many articles on called Seeking Alpha, that's the origin of the name. They are seeking the ability to constantly beat the market. So if you know someone who's really good at trading, you can say that this person has alpha. Now, I don't have alpha because I don't believe anybody has alpha. Having alpha would mean that you're some sort of psychic, and nobody is. So I don't have alpha. I have systems that allow me to look at the numbers and the data and predict with a high amount of accuracy which way a stock is going to go. Now, people with bad systems have the opposite. They continue using their system because it's really hard to be a bad investor, because if you have a system and it's not working for you, you're probably going to change your system, right? But there are some traders out there who, I guess, they attach the system to their egos, and they are adamant about sticking with the system even though it's been proven time and time again that that system doesn't work. It produces really bad trades. Now, the benefit of that is that if you find an investor just like that, you can use the opposite of what he says as your trading strategy. All right? So what I'm going to show you today is 3 sources, free sources, that allow you to get this kind of inverse guru strategy. So obviously, if you sign up for my strategy, you just copy my trades. You copy what I do. But if you don't want to pay $99 a month for my service, what you do is you go find a really bad guru and you do the opposite of what he says for free, right? These bad gurus typically give out their advice for free. I'm going to show you them in a second. But first, a really quick story. I read a book about a hedge fund owner who hired a bunch of traders, and then he would follow those traders' advice and see which traders paid off. Now, there's this one trader who gave really bad advice, and the hedge fund manager led that trader on to believe that the trader was doing a really good job. So the trader would make the trades himself. He would pass off a report to the hedge fund manager, and the hedge fund manager would do the opposite. And eventually, what the hedge fund manager did was he promoted that trader, and he said, look, you're doing really good. Here's a promotion. The trader was oblivious to the fact that the hedge fund manager was doing the opposite of what that trader said every time. Now, attached to this promotion was a nice vacation package. So that trader went on a vacation, and during the vacation, he did a lot of studying. He tried to up his game because he felt that now with a promotion, he has a higher amount of responsibilities, and there's more pressure on him to be correct. So during his vacation, he studied up on trading, and when he went back to the company, the hedge fund manager found after a short period of time that that trader was not really that bad anymore. The trader was more like the middle ground investment guru. He was right half the time and wrong half the time. So that trader, by improving himself, lost the hedge fund a lot of money, and he was eventually fired. Now, that's just a good story on how you can keep someone oblivious to the fact that they're the opposite of skillful and profit from their lack of skill. We're going to look at 3 sources where you can get really bad trades and then do the opposite. All right? 2 of them I don't care about bashing. One of them is a fellow contributor on Seeking Alpha, and I have nothing against this guy. It's just that a lot of his trades, well, he's proven time and time again to be on the wrong side of the trade. Nothing against the guy, don't know him personally. I'm sure he's a good guy. I don't want to hurt him or defame him in any way. I just want to point him out as a source to do the opposite when you see his advice. So we're going to start with him. His name is Marcos Comines, and you can find his articles for free in Seeking Alpha. Just type his name in. So once you get here, you'll get a list of articles, and generally you just do the opposite of what he says, and you'll be pretty good to go. This guy focuses a lot on the gold market, so if you are a gold trader like I am, then following this guy is probably going to be beneficial to your gold trading strategy. Now, we can look at a few examples. So today I traded Nugget, NUGT, which is a 3 times leveraged gold ETF. So we're going to take a look real quickly. This is the monthly. Now what happened was when the market opened, I bought some calls on the Nugget, and here's the daily. So what happened, we'll go back one day. So this is the previous day right here, and you see this gap, that's showing when one day ends and the new day begins. So at the beginning, I bought, at market open, I bought some calls because the FOMC meeting, the Federal Reserve meeting, was going to post its minutes, or post its, not its minutes, but it was going to report on whether it's going to raise interest rates in the future. Now, generally, if the interest rates are not to be raised, if they're going to be kept at a low level, investors want to put their money in gold or other currencies or commodities that might not have a yield but still look good relative to a really low yield on the money itself. So now in the US we have interest rates bordering on zero. We're almost at zero, and I'm thinking we're going to go into negative interest rates soon, sometime in the next couple years. But for the moment, what I was trying to do with going long on gold was speculate on the FOMC meeting, and that's what I did. So I bought calls, I bought Nugget calls, I waited for the FOMC meeting, and you can obviously see something was happening around here. That was when the results of the meeting were posted to the public, and what happened was the meeting determined that rates would stay the same. They were not going to be raising rates. So gold rallied, and you can see on the Nugget it moves really far in terms of dollar value. So if you're buying a call option, you're essentially getting $100 profit for every $1 movement upward. I bought out of the money calls. I was aiming at a $150 price target. We didn't exactly hit it, but we got really close. My calls cost $300 and I sold them at $600. So that's a 100% ROI. I doubled my money in one day based on that prediction. So that was my prediction. Now, what about Marcus? Well, Marcus predicted that the gold bubble would pop and it would be better to short the gold bubble. So he was in the wrong direction there. And because he posts very frequently, if you're trading gold every day, I trade gold almost every day. So this is a good guy to go to get info on gold for, short-term trend. So let's say you're not sure which way you think which way gold is going to go. Well, you can check this guy out and see what his most recent prediction on gold is. He also was predicting that the Federal Reserve would be hiking the interest rates. That was the point of this article here. Well, as we know from the result of the meeting, the interest rates are not hiked. They are the same as before. So again, a incorrect prediction, and the inverse of what he said would have been a great trading strategy. Now you can just scroll down here, and he's got a lot of articles. He writes very frequently, so he's kind of like that trader in the hedge fund example that I just mentioned. Now one thing I wanted to say is when you're vetting these investors, one or these advisors, one really good thing to look at is what their predictions or positions were previous to a market correction or market crash or some sort of market-wide event. Now, the most recent one in the US was Brexit. So if you go and look at the positions of a trader or investor prior to Brexit, you will see whether this guy was able to predict if that event was going to happen, and number two, see whether he had a portfolio that could have benefited or be hedged against it. Now, you don't have to find someone who can predict or who has predicted every market event, but you should find someone whose portfolio is hedged to where he's not hurt if he doesn't predict an event. Now, Marcos, let's see here. Marcos was... Alright, so Brexit happened on June 24th, and let's see, yeah. On June 20th, Marcos predicted that the stocks would go to a new high and that the gold bubble would burst. Well, the opposite two things happened. At Brexit, stocks fell and gold rose to actually new heights. If you want to take a look at the monthly gold, actually here's Nugget. So June 24 is right here. That brought us to a new trading region for gold, right? So I'm just saying, this guy's articles are good ideas to play the inverse trade on. I'm not saying he's a poor investor or poor analyst. I'm sure he's got his good points, but for the macro issues and for issues on gold, he's wrong, I would say, most of the time. So he is actually a good person to follow for inverse advice that's free, right? So number two source, we're going to move on to the second source, and the second source is Reddit. Now, I'm not familiar with Reddit. I don't actually use it, but it is very popular, and it has these little like sub-forums. They call them subreddits, and there's multiple subreddits. So there's one on investing, which is a long-term trading strategy, clearly, and then there's one called Wall Street Bets, which is short-term, and it's kind of like what I offer in Exposing Earnings, my earnings newsletter, because what they're doing is they are predicting what is going to happen after a stock reports an earnings report, and they are wrong very often. I think most of the time they're wrong, and I've been actually looking at them for the opposite plays. Earlier this week, I remember reading this forum and finding them to say that they should go long on Guild. We can look at them. So they said to go long on Guild before earnings. Guild fell. They said to go short on Apple before earnings. Apple rose. What else? I forget what else, but we can take a look in a second. But the idea here is that they have been wrong pretty much every time, and I've paid attention to it because I happened to actually come across this very recently, and I found that their predictions were the opposite of my predictions. So I was like, whoa, is this representative of the public? I'm not sure what's going on here. So if you look at my predictions, I said Netflix is going to report earnings, and we need to take a short position on Netflix. We should buy puts. I said the same thing. I said for Facebook before it reported earnings, and it just reported today. I said, hey, Facebook is going to kill it. We need to buy calls. We need to take a long position, buy these calls. And what happened to Facebook? It's way up today. So it was really weird to me because I put in many hours in researching these earnings predictions so that I can write these reports for my subscribers, and then I go to this Reddit site and I find them saying the exact opposite of what I had predicted. So I'm thinking either these guys are just a group of idiots, or I'm really, really screwed up in the way I make my predictions. Well, luckily, they're wrong most of the time, and so far I've been right every time they've been wrong. And why I'm pointing this out is because recently they put out this, they did some sort of study. Let's see here. Where's the study? I think this is it. They put out a study on, they took a survey. Okay, so Reddit took a survey of all its users that were making predictions. And by the way, one good thing about Reddit, this forum, is that these people have a rule. You'll see in a second. There's a rule that if you're going to trade, you have to have proof or you get banned. So everybody who's pointing out that they're going to buy something or sell something actually are buying and selling those things. So not only are they confident, but they also have skin in the game, and they have put money into the stock market. The ironic thing is that they're wrong most of the time, so pretty much everybody's just putting proof up on this forum that they're losing money constantly, and I'm pretty sure there's going to be a lot of churn here. There's going to be a lot of new users pretty much every week as people come in, lose all their money, and then leave this place. Now, obviously, you don't want to be like that. You want to do the opposite, but just really quickly, here's evidence that they're really bad. So you can see that the green is the amount of people who are betting in the positive direction, red is the amount of people betting in the negative direction. These are the Reddit forum goers. And then you'll see the results up on the top left. So here, the stock went down, but everybody was betting that it goes up. Stock went down, everybody was betting it goes up. And you'll see this time and time again in this report. It shows basically that these guys don't know what they're doing. And it's going to be a pretty good source for you if you want some free information on what earnings plays to play. Just remember to do the opposite of what they're recommending. Now, there's going to be a caveat, I think, coming up real shortly, because if they're tracking their data, they might actually improve. And apparently this data tracking thing is new as of this week. So really, if you measure something, you're going to want to improve because you're going to see yourself as a really bad investor. And they're probably going to find some ways to get good. That's a possibility. Another possibility is that it's just going to be a system of churning bad investors. So investors will come to this site, they will put their advice up on the forums, other people will follow their advice, everybody will lose money, and then they will leave the forum and never come back. That's another possibility. But for now, this is a pretty good source of finding out good trades. Just, again, remember to do the opposite of what they say. Alright? And in this case, pretty much the most confident, I think, yeah, it said that in the results itself, actually. The most confident trades, where are we? Is this it? I think I lost it. But what they found was that the more confident they were, the more likely they were to be wrong. So when the whole group is saying this stock is going to win, this stock is going to beat on earnings, it's much more likely that the stock actually misses on earnings, and you'll make more money, of course, if you're going with a more confident group of people. So if they're split kind of like 59-41, it's probably not a good trade. But here you got 75-25. Well, that, because those numbers are so whole, it probably tells you that there's only a handful of people. But actually, I remember this. Gilead, on Monday, everybody on the forum was like, yeah, this stock is gonna it's gonna beat on earnings. It's gonna be a great buy. Everybody buy it. I'm putting in lots of money on calls and I'm buying the stock outright. And then, well, as I predicted, it fell. So there you go. Alright, so let's move on to the third source. Third source is, everybody knows this guy, Jim Cramer. Jim Cramer is a really bad investor, and I think he's a really dangerous guy to take advice from, because right before the stock market crash in 2008, he was totally in damage control, telling people, alright, things look bad right now, but don't take your money out of the market. and that advice probably made a lot of people go broke. I'm not sure. I haven't really listened to this guy a lot, so I'm not sure what kind of person he is. I'm not sure if he's a sociopath, or if he really thinks that he's right, or if he thinks that he's really doing something good. But the problem with this guy is that he's a permabull. He thinks that the market's always going to go up. I think that's his motto for the show, too. It's something like, there's a bull market somewhere at all times. So this guy's the type of guy who just buys and holds forever until the stock market crashes and then loses a lot of money. Now, the reason he's famous, I think, is because he's so bullish on the economy, and the mainstream media really wants they really want people who will give advice that's positive and optimistic. So they would much rather prefer this guy who says, buy Apple, buy Gilead, who's always giving optimistic buy recommendations, instead of someone who comes on and says, look, the economy's not that great, guys. It's probably not a good idea to be buying stock right now. It's probably a good idea to be shorting stock right now. The media doesn't like that. It doesn't fit with the narrative that the U.S. economy is doing well. So I think this guy's always going to have a place, and he's always going to be famous. But if you need any proof that this guy is not too good at his, well, he's got two jobs, I guess. One is kind of trumpeting the bull market, but his other job is actually picking stocks. He's not too good at picking stocks. And there was an economist, or I think it was this guy, David England, a retired finance professor, called Jim Cramer out. So he said, look, Jim Cramer, if you're so confident on your trades, why don't we place some bets? All we need to do for this bet is you build a portfolio, and then at the end of the year, we'll see if the portfolio beat the market or not. Now, Jim Cramer said, no, I'm not going to do that, which is pretty shady, in my opinion, because it means that he's not confident in his picks. Well, what happened was David England said, well, okay, I guess we're not going to do it, but if we're not going to do it, I'm going to do it without you, and I'm going to make the results public anyway. And he did this. Now, here are the results down here. What he did was he took 49 of the stocks that Cramer recommended, all of them. So this is actually another complaint with about Cramer. He makes so many picks for every newsletter he writes that he's always going to have one or two that pay off well, and he's going to come back and say, I nailed it. You know, I predicted that it would go up. A week ago, I predicted it would go up, and I was right. But he conveniently ignores the other 50 stocks that he recommended. Now, I try to avoid that. So for the Exposing Earnings newsletter that I write in Seeking Alpha, what I do is I try to just stay with one earnings prediction per week. So it's a lot more clear if I'm doing good or bad. And so far, we have a prediction rate or an accuracy rate of 93%. So we've been right the majority of the time. Now, back to Cramer. You can see that his entire portfolio was red. And the result was something like 67% lost money. You can read this article. You can Google this stuff. But there you go. That's the point of this article. You've got 3 sources to begin using inverse trades on, or at least developing a strategy on the stocks that are mentioned in those 3 places. When you begin trading, one of the hardest things, if you're trading frequently, is choosing the stocks to trade. Now, if you have sources that are telling you this is a good stock to trade or this is not a good stock to trade, it's a lot easier and a lot less time intensive just to create your trades from those stocks that are mentioned, instead of having to do the research to pick the stocks yourself. So what you would do basically is choose one of these sources and then pick the most confident stock. So pick the stock that Jim Cramer is saying that he really likes, or pick the one that Reddit is talking about the most and is clearly in consensus in which way the stock is going to move, or pick any of this guy's stocks. But that's your starting point. You can start out with a stock, in other words, that you know with a high probability is going to move in a certain direction. That direction being the opposite of the direction that, let's say, Marcos says. Once you got that, you can do your own research. You can employ your own strategy or analytical method to that stock to see if your method also is in alignment with the opposite of what Reddit, for instance, says. And then you might find that you're doing actually quite well, even though you just started trading. And part of the reason is that you're starting out with a position that's already more likely than 50% to be right, because you've chosen the inverse of what these guys recommend. So I think that's all I really have to say. I'll be doing a podcast soon, and in that podcast, I think I'm going to talk about the effect of confidence on being wrong. The more confident a person is, the more likely he is to be wrong. Except for me, I'm very confident, but I'm actually quite perfect in many ways. So if you see that Jim Cramer is especially confident today on Mad Money, you might pinpoint that stock, write it down on your watch list, and go the opposite direction with it, because the probability that he's wrong is, well, it's been proven now that it's around 70%. And we also have statistics for this one, whatever I just showed you. So I guess, here it is. First round of WS Wall Street bets earnings are in. The results won't shock you. So at least they are self-aware that they're not good at what they do. And if you click on the data, you can actually calculate it. I think it's this one. You can calculate it yourself. I don't think they've calculated it yet, but all you have to do is see whether the green in the pie chart and the red up here match or don't match. So this was a wrong prediction, right? So this was a correct prediction. Sum up the correct predictions and then divide by the number of predictions, and there you've got the accuracy. I'm not sure if they did that here. They did. Out of 20 plays, they were correct 8 times, so that's almost random, unfortunately for us, because we wanted something more inverse. We wanted something worse. But I think they mentioned something about, the more confident they are about their guess, the more likely it is to be wrong. So if you come here and you saw, like I did on Monday, everybody saying Apple is totally going to miss on earnings. Everybody was talking about buying puts and how you couldn't fail. And then in the end, Apple beat on earnings and rallied. Now, that confidence shows you that Apple is probably a pretty good buy at that time, and then you can just go through with your analysis to confirm. So that's all you really got to do. That's how you can pick stocks without having to just have a long list of stocks where essentially you've got 50-50 bets. Now you're starting with a 70-30 bet, all right? I'm going to be doing a podcast, creating a new podcast this week, so I'll be putting that up soon. If you have any questions for the podcast, please leave them in the comments section below, and I will get to them. Also, before I launch the podcast, there is the contest that is still going on. All you have to do is go to my profile in Seeking Alpha. I think I'm logged in already. Go to my profile in Seeking Alpha and check my post called, I forget the name, actually, but it's just a series of 3 questions. All you have to do is, it's in my Instablog section, there, your biggest problem in trading. Go there, read the 3 questions, answer the 3 questions in the comments section below. I will read them before the podcast, and the person whose questions are the most interesting will get 2 weeks of Seeking Alpha Pro for free. That's a $150 value. So do that before I put the podcast out, and you will be entered into this contest. Please like this video and subscribe. And don't forget to subscribe, forget to like, comment. See you next time.